This might be the biggest financial wake-up call of the decade, and no one's ready. Moody's just downgraded the U.S. credit rating, and that's not just a headline. It's potentially the trigger for a full-blown U.S. debt spiral, made worse by a silent, brewing threat that almost no one's talking about: commercial real estate. The perfect financial storm is forming. And the most critical insight? That comes at the end. So watch closely from the start to the final piece. If you care about protecting your wealth in uncertain times, like what we're about to break down, this episode will give you facts that could directly impact your future. This is Endgame Compass, straight facts on global power plays and economic shifts. If you support what we're doing to spread rational, accessible financial intelligence, and believe truth and knowledge make the world safer, we invite you to back our mission. For less than the cost of a coffee, you can help fuel our work. Just check the video description or visit our channel to learn more about how you can support us. And if you find this episode valuable, please share it with friends. Help us spread the insight. Now, let's dissect what's really going on behind the headlines. Let's start with something most experts didn't predict: the sharp rebound in the U.S. stock markets recently. It took just a few days for the entire sentiment to shift, from full-blown panic to euphoric optimism. One moment, people online were accusing analysts of encouraging catching falling knives, and the next, those same stocks, Google, Microsoft, and Ferrari, bounced from their lows right after. What does this tell us? Short-term market sentiment can often be irrational. Fear makes people sell at bottoms. Greed makes people buy at peaks. And if you want to actually make money, not just follow the crowd, you need to act against your instincts. That's why long-term investors often find their best opportunities when panic is at its peak. Using a disciplined buy low, sell high approach with quality assets over time can yield results. Here's the key insight: market emotions are often a reverse indicator. We're seeing optimism creep right back in. 3 straight green candles, and suddenly all previous worries are forgotten. Investors have already returned to risk-on mode. But this could be the most dangerous time, when fear has faded, because beneath that surface optimism lies a crumbling foundation. Smart investing isn't about blindly joining rallies. Now's the time to explore opposing viewpoints carefully, especially as credit conditions tighten and macro risks loom large behind the scenes. Here's the big one: Moody's, one of the world's top rating agencies, just stripped the U.S. of its AAA credit status. This follows similar moves by Standard & Poor's in 2011 and Fitch in 2023. What does that really mean? It's not just symbolic. It signals the end of an era, the end of the U.S. being seen globally as the gold standard of safe assets. Owning U.S. Treasury bonds used to be the definition of risk-free. Now, not so much. If our credit rating keeps falling, so does investor confidence. After Moody's downgrade, the markets reacted immediately. U.S. 10-year Treasury yields shot up to 4.49%. Stock index futures dipped. The dollar weakened. Meanwhile, policymakers scrambled to push back, but the damage was already done. And let's cut through the noise. No nation can borrow endlessly without consequences. America borrowed too heavily. Now bills are coming due. Here's where it gets more alarming and more technical. The U.S. Treasury is planning to issue more than $2 trillion in new debt. It has to. It must roll over old debt with new, otherwise it can't pay what's already due. But the question is, who's going to buy all this? Foreign buyers are pulling back. Many worry that treasuries could be weaponized, or that risks of inflation and dollar devaluation are too high. That leaves primarily just one buyer: the Fed. And if the Fed steps in and buys this debt, it does so by printing money. That worsens inflation, reduces confidence, and can trigger a vicious loop. What Citigroup analysts and others now warn may become a death spiral. Why? Because rising yields lead to higher interest payments on debt, which leads to more borrowing, which leads to even higher yields, and around we go. A self-made doom loop. Some analysts are already calling this the beginning of a US version of the UK's 2022 bond market crisis, only bigger. Hold on, because it gets worse. While people panic about bonds and inflation, there's another threat lurking in silence: commercial real estate. This sector is already on shaky ground. Vacancy rates in U.S. office buildings are sky high. Cities like San Francisco are nearly 37% empty. New York, around 20%. Commercial property prices have plunged, especially for office spaces. Millions in loans coming due. Worse yet, 70% of that commercial debt is held by small and regional American banks. If values plunge and borrowers can't refinance with higher interest rates, banks will be left holding worthless collateral. That's a financial stability crisis. Warren Buffett, Charlie Munger, even Blackstone all acknowledged this risk over a year ago, and the data keeps affirming it. Commercial mortgage-backed securities, CMBS, are seeing record increases in default rates, particularly in office space loans. This could be the next Lehman moment. And we've seen this movie before. Real estate cracks slowly, then all at once. In 2005-06, U.S. housing defaults started appearing, but the real collapse came in 2008. We're watching something similar now with commercial property, a ticking time bomb, just waiting for the final spark. So why hasn't the Fed just rushed to cut rates and save the situation? Because inflation hasn't gone away. While some headlines showed a drop in CPI, we need to consider how lagged these numbers are. According to BlackRock and Goldman Sachs, the real inflationary impacts are just beginning to show up. Goods like electronics, autos, and clothing are all being hit. Tariffs could escalate this further, especially if future administrations weaponize trade tools again. Now, here's the trap. Reducing rates could fuel another inflation surge. Not reducing rates means letting highly leveraged sectors like real estate burn. The Fed is caught between a rock and a hard place, and Powell knows both outcomes are ugly. Now, before we move deeper into this crisis, if you haven't already, like this video, and make sure you're subscribed to Endgame Compass. Turn on the notification bell so you never miss timely information like this that could protect your hard-earned assets. Because we break financial stories with clarity and urgency, often before the ripple hits your wallet. Here's the strangest twist in this entire situation. As institutions quietly exit the markets, retail investors have stepped in aggressively. Bank of America's data showed that individual investors have been net buyers of stocks for over 21 straight weeks. In contrast, institutional funds have dumped over $1.5 billion in equities. Yet, prices keep climbing, because retail volume now dominates direction. The joke used to be smart money sells to the dumb money. But lately, retail is winning. Or are they? This could eerily resemble 2007, just before the crash, when small investors went all in at the peak. Remember, retail euphoria at highs often precedes steep corrections. So where can investors look for safety? One answer is once again shining: gold. Gold's appeal isn't just as a hedge against geopolitical instability. It's also now making a comeback as a potential alternative to fiat anchors. As faith in the dollar's long-term dominance erodes due to debt, inflation, and geopolitical shifts, a new global question arises. What's the next trust-based anchoring system? Central banks around the world are already ramping up gold purchases. Institutions like Bridgewater have increased their gold ETF holdings. If the Fed ends up being the only buyer of U.S. treasuries, history tells us, people turn to hard assets. And gold? It's the oldest hard asset of them all. The U.S. is heading toward a critical convergence point. Moody's downgrade isn't just bad optics. It's a structural shift in how the world views U.S. debt. But the bigger blow might come from mounting defaults in commercial real estate. Why? Because they feed into each other. As commercial properties default, more bank failures will shake depositors, leading to heightened credit risks. That requires more government intervention, which ultimately means even more debt. More debt means more printing and the possibility that no one, except the Fed, will buy our bonds. That erodes the dollar, leading us right back to inflation. Meaning, inflation isn't going away anytime soon. It could be the final form of this crisis. So what can you do? Stay informed, diversify intelligently, and question overly rosy market narratives. This is a time to step back and look at the macro chessboard, not just the daily ticker. Leave a comment below. What's your take on the U.S. debt problem? Will real estate be the breaking point? We read and respond to thoughtful input, and your ideas help us build better episodes. If this episode sparked a new insight for you, share it. Someone in your network might need to hear it now more than ever. Thanks for watching. We'll see you in the next breakdown.